Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Today we're going to ask a simple question. Can we construct a portfolio that will outperform the three-fund portfolio? For those that aren't familiar, the three-fund portfolio is just a simple, well-diversified investment portfolio that consists of, as the name suggests, either three mutual funds or three ETFs. One would cover U.S. stocks, one would cover international stocks, and one would cover bonds. I personally think it should represent the sort of the foundation of any investment portfolio. But the question is, can we do better than that? And the question came up from a viewer named Jeff. He emailed me, and he talked about two of the tools that I use a lot on this show, and we're going to use today, that he really likes. One is Personal Capital, one is Portfolio Visualizer. He had Personal Capital do an evaluation of his, effectively a three-fund portfolio. We'll look at it in just a minute. And Personal Capital had a couple of concerns. The first was they said, look, it's heavily weighted towards large companies, and in particular tech. That was concern number one. And then the second and somewhat related concern was they didn't feel that he had the sufficient diversification. And in particular, they were looking for more commodities exposure, perhaps gold, more REITs, more small cap. And so that really is the question for today. If we add some of those things, what will that do to the portfolio? And can we maybe, over time, beat the performance of the three-fund portfolio? Now, Jeff is retired, so we're going to look at this from the viewpoint of someone who is starting to spend their money. So, having said all of that, let me first show you his portfolio. And so this is a demo version of Personal Capital. These are portfolios I've talked about in past videos. And this is more or less Jeff's portfolio. He does have a few other things like cash, but this was sort of the core of it. Now you can see this isn't actually a three-fund portfolio, it's a four-fund portfolio. And that's because the bond portion of this portfolio is actually divided into two funds. One, VBTLX, which is a U.S. total bond market fund, but there's also an international bond component. And that's pretty common for Vanguard when you look at their target date retirement funds, their life strategy funds. And I think this was built by their advisory services. I understand Jeff's email. They tend to include international bonds. But for practical purposes and our purposes today, we can think of this as a three-fund portfolio. But here it is. And so let's go through the two concerns that Personal Capital has. The first is that it's heavily weighted towards large cap and in particular tech. So how can we look at that in Portfolio Visualizer? Well, we can come up to allocation, and we'll focus on U.S. stocks for the moment. And they give us a great way to look at allocation, and we can look at this and say, boy, sure enough, the boxes that represent large cap, they're a lot bigger than the mid cap boxes here, and they're even bigger than the small cap down below. And so sure enough, we could do the same thing for international, but for U.S., sure enough, it is heavily tilted towards large cap, and you can even see that in the numbers. Here, the large cap here, you're looking at maybe almost $300,000. We come down to small cap, and by the way, I assumed $1 million portfolio. The small cap, we can look at that, and that's maybe 30,000. So there's a huge difference. And then we can come over to U.S. sectors, and we can see, sure enough, technology, 24.68%, by far and away the largest sector. And as compared to some like, say, basic materials, boy, or utilities, the difference is night and day. And so the first thing to note is Personal Capital's observation is correct. His portfolio is heavily weighted towards large companies and tech. And for that matter, any three-fund portfolio, whether you used Vanguard funds, Fidelity funds, whatever, the same would be true. Now, is that a feature? Or is that a bug? And I think there are two ways to look at it. Understand this, that the idea behind the three-fund portfolio is to try to mirror the market as best as we can. And the market favors larger companies. There is more capital invested in Apple, a very large company, than many of the small companies in the S&P 500 or in a total U.S. stock market fund that you and I have never even heard of. And the same is true with tech, at least right now. More capital is invested in tech companies than in any other sector. So the idea in Jeff's portfolio as it exists now, and with a three-fund portfolio generally, is we're going to mirror the market. And if that means large companies overweight or have more invested in it than small companies, so be it. And if right now it happens to favor tech companies, that's just the way it is. We're not going to try to outsmart the market. We're just going to try to mirror the market. Now, one thing to point out is when we look at the history of returns, for example, the S&P 500, and we see that history going back, they can have the data going back even before the S&P 500 as we know it exists. They can recreate it, go back 100 years or more. And it's done, of course, very, very well. And it's always been the case that the S&P 500, same would be true with the total stock market index, has been heavily weighted to large companies. Now, they haven't always been heavily weighted to tech companies. Sectors come and go over time. But with these, maybe faults in the way cap-weighted index funds are created, they've done extremely well. And so I think a lot of people, myself included, think, do we need to mess with that? Yes, it's weighted towards large cap companies, but so what? That's how the market is weighted. We just want to mirror the market, and it's done well over a very, very long period of time. Of course, in the short term, it can do poorly, but that's true of any investment. Over the long term, it's done very, very well. So I don't actually see that as a bug. I see that as a feature of index funds generally, and the three-fund portfolio in particular. Now, having said that, it doesn't necessarily mean that we can't make some additions to the three-fund portfolio that make us more comfortable individually, depending on your own perspectives on investing, and perhaps give us at least a different kind of diversification. I won't necessarily say it's a better or more diversified, it's just different. And that gets me to the second question raised by Personal Capital, and that is, should Jeff have more exposure to REITs or to maybe to commodities or small cap, and how should we even think about that? Now, the first thing I want to point out that I think is really important is that he has exposure to all of those things now. If we go back to the allocation, right, he has exposure to small cap. If we look at sectors, we can see that he has exposure to like basic materials, which would be commodities. You don't see it here, they don't break it out, but he has exposure to real estate. In fact, what we can do very quickly is go over to Morningstar and see a different set of sectors for, say, VTSAX, which is the Vanguard Total Stock Market Index, right? And if we go to Portfolio, we can see down in the sectors, here we go, real estate. So he has exposure to real estate. He has exposure to commodities, again, through basic materials. And think about a company like Deere & Company, which would have exposure to food commodities, right? And he's going to have exposure in the construction industry to lumber. So the issue isn't that he doesn't have small cap exposure or real estate or even commodities. In fact, his exposure is basically in line with the market. The question is, should he overexpose in those areas? And it's very important. He does have exposure to those sectors. The question is, should he have more? Now, one way to answer that is to look at history. And so what I want to do here is use Portfolio Visualizer. And I'm specifically using their Monte Carlo tool. And I'll show you where you can find that. If I just jump over to the home page briefly, if I can. On the home page, you'll find it right down here. This is the link, Monte Carlo simulation. It brings us to this page. And what I've assumed, and this is because Jeff's in retirement, $1 million portfolio. He's going to take out $45,000 in year one, so this would be a 4.5% initial withdrawal. He's going to adjust that amount for inflation annually, and we're going to simulate a 30-year period. And we're using historical returns for the simulation model. You can use other things, but this is a Monte Carlo simulation. And here we have the three-fund portfolio, and I've divided it 50% US stocks, 20% foreign, and 30% bonds. And when we run that simulation, which I've already done, let's take a look at the data. And we actually looked at this in a previous video recently, but what this shows us, the 90th percentile would mean if he gets really lucky, 10% of the time, he could have started with a withdrawal rate, if you can see that, of just over 10%. Now, most of the time, he couldn't do that. Most of the time, the money would not last 30 years if you started with that high of a withdrawal. And then the question becomes, all right, well then how conservative do we get? Well, following the 4% rule, I know we're starting off at 4.5, but the 4% rule as envisioned by Bill Bengen, he would go all the way to the other end. We would be as conservative as we possibly could be, just to avoid the risk of running out of money. And you can see here the way they've simulated it, given all the assumptions, including the way I've allocated the three-fund portfolio here. He could start with actually 4.81%. His money would last 30 years. This is assuming not the absolute worst case. This is the 10th percentile, but it's certainly on the bad side of scenarios. And you can see an ending balance, portfolio balance, without factoring in inflation, of $410,000. Now, we can now compare that. I want to bring you to this second Monte Carlo simulation window. Again, we've got all the same assumptions here. And we're going to start with REITs. So what I've done is I've got the same three-fund portfolio. I've added REITs, and I've taken the 10% here. I've taken it out of the U.S. stock market. So I'm going to leave international and bonds the same. If we run this simulation, how does it compare? Well, we can see that it doesn't change a lot. On the 10th percentile, it actually lowers the safe withdrawal rate, not by much, under 10 basis points, but the ending portfolio value has certainly come down. And if we go to the top end, that's gotten a little worse as well. So at least based on this Monte Carlo analysis, using inputs from historical data, adding REITs, at least in the percentages I'm showing you, didn't help us out. Now again, how this would look going forward 30 years, there's no way to know. But I think this gives us at least some idea based on Monte Carlo analysis using historical average returns and standard deviation, what it might look like. Now, instead of using REITs, let's use commodities. 10%, we'll run this simulation. And you can see with commodities, things get pretty significantly worse for us, actually. The safe withdrawal rate drops to 3.5 at the bottom, and we basically die after 30 years with no money. And even on the top end, things get worse. So that's commodities. And now let's look at, we'll look at gold. And gold actually fared better. It still underperformed a little bit at the bottom end, but not by any what I would consider significant amount. It definitely underperformed a little bit more in the top percentile. But for the trouble of adding another asset class and fund, I'm not sure that helped us. The last one I'd like to look at, though, is small cap value. Here we go. Run this simulation. And this one actually may have helped us a little bit more. The safe withdrawal rate goes from 481 up to 495. We die with a little bit more money, actually a lot of bit more money, at least on a nominal basis, but even on a real after inflation basis, it's a pretty significant difference. At the top end, I would say the difference not nearly as significant. It's a little better, but not by much. So this could suggest, again, based on all the assumptions we've talked about, that adding small cap value could help with the results. Now, we could, of course, change this percentage. We could add small cap value and REITs and put, 7% in each, and then take this down to 36. And then we could run these numbers. And we could go on and on and on forever. Turns out that didn't make much of a difference. And get different results. So having said all of that, it raises the big questions like, Rob, look, I appreciate that portfolio visualizer. I see it. It's a neat tool. Love personal capital. Great. What do we do with all of this? At the end of the day, I think the most important question to ask yourself, and this is true not just for someone like Jeff or perhaps me in or nearing retirement, but even if you're many years away from retirement, is what's the portfolio you can invest in and stick with it for the long term? And a lot of folks want that little extra diversification. I think small cap tends to be the one that I hear about the most, particularly small cap value. But you also hear a lot about wanting more money in real estate, and that's fine. But what's the portfolio that you're the most comfortable with that you can stick to no matter what? Because here's the reality. No matter what you decide, there are going to be some times, again, within some range of reasonableness, but no matter what you decide, there are going to be times when it underperforms, say, a basic three-fund portfolio, and there are going to be times when it outperforms a three-fund portfolio. And so you have to have something beyond just relative short-term performance that keeps you invested in the portfolio that you choose. Now, for me personally, I've always had a little more exposure to small cap, usually around 10%. For long periods of time, I had extra exposure to REITs and emerging markets, although not always. Those were the choices that I've made. Again, I think I feel the most strong about small cap, and in particular small cap value, in part because it just suits my own sort of general approach to investing. And so it's the one, I'll call it tilt to small cap and small cap value, that I've basically had as long as I've been invested. Doesn't mean it's right for you, doesn't mean it's right for Jeff, but that's the question you have to ask. I do think looking long-term, small cap value, if you've added it to a three-fund portfolio, has outperformed a three-fund portfolio standing by itself. Again, that doesn't mean going forward it will continue to do that, or over any specific period of investing it will outperform. Maybe it won't, but long-term it certainly has, and it's been an approach I've taken and I've been comfortable with it. Now, one last thing to keep in mind, and it's something that Jeff mentioned in his email to me. If you use an advisor, whether it's Personal Capital or someone else, to manage your money, you've got to pay a fee. Now, the industry average is around 1%. Personal Capital is lower than that. There are others that are even lower, like Vanguard, Personal Advisory Services, or maybe a robo-advisor like Betterment. One of the things Jeff said in his email to me, and I think it's so important, he understands the percentage fee that in this case Personal Capital charges, but what he did was he translated that number into an actual dollar amount. He's put that in the email to me. He said, if I go with them, this is the actual dollars, the fee in dollars that I'm going to have to pay each and every year. And he's evaluating whether he wants to work with them or perhaps someone else or perhaps no one based on the actual dollar amount of the fee. And I think that is so very, very important. You're going to get a fee quoted to you as a percentage, typically. Translate that into actual dollars, because that's what's going to be coming out of your account every month or every quarter. And that's what you need to evaluate in deciding what's best for you. Well, I hope this video has been helpful to you. As I said, there are no guarantees about the future. I tend to like small cap and small cap value. I think some extra exposure to REITs can be justified. But whether adding those to a three-fund portfolio will outperform a three-fund portfolio over your investing time horizon, there's just no way to know. So you got to do what you think you can that will keep you in that portfolio long term. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.